Welcome to this explainer. Today we're diving straight into the SASB standards for the investment banking and brokerage industry. Specifically, we'll be looking at how tracking massive institutional risk right alongside individual banker bonuses is actually the key to protecting our global financial stability. It's a fascinating intersection of massive corporate structures and individual human behavior.
It sounds almost like a Hollywood script, right? Can a single banker's bonus really crash the global economy? But as recent financial crises have shown us, painfully I might add, excessive short-term risk-taking at the micro level by individuals chasing massive payouts can absolutely trigger a macro-level disaster. The standards we're unpacking today are designed to expose and manage exactly that kind of risk before it spirals completely out of control.
Okay, here's our roadmap for today. We'll be covering 1. Preventing the next crisis, 2. Grading the global giants, 3. Surviving the stress tests, 4. The material risk takers, 5. Fixing flawed incentives, and 6. Securing long-term value.
Section 1. Preventing the next crisis. We really have to start by looking at exactly why investment banks are scrutinized so heavily by regulators today. Think of it this way. These massive banks do not operate in a vacuum. If they mess up their capital risk management, the sheer interconnectedness of our global financial system means, well, everyone suffers. When one major player stumbles, the shockwaves travel through markets worldwide, wiping out asset values and spiking liabilities everywhere. So regulators realize that managing this systemic risk isn't just about saving one bank. It's literally about saving the entire economic ecosystem. Moving to Section 2, Grading the Global Giants. To prevent these global dominoes from falling, regulators built a highly specific grading system. Banks actually have to disclose their Global Systemically Important Bank, or GSIB, score. And it's not just one arbitrary number. They have to break it down across these 5 distinct categories. This transparency forces the institution to openly prove to investors and regulators that they are actively managing the very real risks associated with their massive size, their international reach, and their sheer complexity. It's essentially a public report card on how dangerous a bank could be if things go wrong.
Section 3, Surviving the stress tests. Because, honestly, just getting a score isn't nearly enough. Knowing your risk is only half the battle. These banks also have to prove they can survive a theoretical economic nightmare. It's essentially a mandatory fire drill for their balance sheets. They must prove they have enough capital and liquidity to take a massive financial hit, keep operations running, and meet their obligations, all without needing a taxpayer bailout. It's all about ensuring resilience when the economy takes a sudden, unpredictable nosedive.
And simply passing the test? Not enough. SASB standards demand that banks disclose exactly how they integrate these stress test results into their everyday survival plans. Investors need to see that this data actually shapes long-term corporate strategy, dictates capital adequacy planning, and even informs their environmental, social, and governance goals. The data actually has to drive business decisions.
Section 4. The material risk takers. This is where we transition from the giant, faceless institution down to the individual humans at the helm.
Enter the MRTs, the material risk takers. These are the specific people within the bank whose daily, micro-level choices dictate the safety of the entire macro institution and, by extension, your economic security. It's a crucial reminder that systemic risk isn't just about bad algorithms or market shifts, it's heavily driven by human behavior and human decisions. So who actually qualifies as an MRT? The standards require banks to track these folks closely, based on some very specific criteria. It covers the obvious players like senior management and board members, but it trickles all the way down to people initiating major credit proposals or making calls on the trading book. And check this out. There's a blanket rule capturing the top 10% highest paid employees. Basically, if you are making that much money at the bank, your actions are, by definition, material to the firm's risk profile.
Section 5, Fixing flawed incentives. Now we hit the core of this explainer, how these material risk takers are actually paid, and how that structure can inadvertently encourage catastrophic behavior.
We absolutely have to scrutinize compensation variations. Look at the 2 standard models. Fixed pay, your standard salary, is permanent. It doesn't push you to take wild swings. But variable remuneration, like those infamous bonuses, is tied directly to performance. Left unchecked, it heavily incentivizes employees to gamble. They might take insane short-term risks for a massive payout today, totally blinding themselves to the threat that behavior poses to the long-term value of the corporation tomorrow.
Because that danger is so real, the standards require banks to disclose the exact percentage of variable pay for these MRTs. This transparency is a huge deal. It tells investors right away, is this bank building a culture of responsible, measured growth, or is it fostering a culture of reckless, short-term greed, where traders are literally financially pushed to roll the dice with the bank's capital?
So what happens when someone does make a reckless bet? Well, to give these rules some actual teeth, banks outline their ex-post risk adjustment mechanisms. If unexpected losses occur, or if a trader was hiding risks, banks use what are called malice and clawback provisions. This allows them to literally reach back and punish bad bets by reclaiming variable pay, slashing the cash, or reducing the value of financial instruments already awarded to those reckless material risk takers.
Finally, Section 6, Securing Long-Term Value. Let's shine a light on one of the most complex, shadowy areas of trading where this supervision is desperately needed.
We've got to talk about Level 3 assets. These are highly complex, often illiquid financial instruments. Unlike a standard stock where you can just pull up the current market price on your phone, Level 3 assets don't have clear market prices. Their value relies on models and significant unobservable inputs. In plain English, they are ridiculously hard to value accurately, which leaves a massive gray area for interpretation.
Because that true value is so murky, a trader could, theoretically, tweak the valuation models to intentionally overprice a Level 3 asset on the books. Why? Just to make it look like they generated massive profits and secure a fatter variable bonus. That's exactly why banks must disclose their strict policies for supervising, controlling, and validating how traders price these almost unpriceable assets. It's a crucial checkpoint against internal fraud and inflated risk.
As you can see, the metrics required for the industry really try to leave nothing to chance. From calculating complex GSIB scores to disclosing stress test integration, right down to the exact percentage of clawbacks applied to a risk-taker's bonus, the financial sector is systematically fighting back against the precise conditions that triggered past crises. So it leaves us with this massive, compelling question. With these strict disclosures tying a trader's personal bonus to the survival of the bank, is the global financial system finally safe from human greed? Well, no system is flawless for sure, but tying the intricacies of an individual's paycheck directly to the long-term survival of the institution is a monumental leap forward. It proves that to truly protect the global economy, we can't just look at the macro numbers. We have to meticulously manage both the biggest institutional dominoes and the very real human incentives pushing them. Thanks for joining me for this explainer, and keep questioning the data behind the headlines.